In this video, I want to talk about how to value different types of businesses. If you're an investor in the public equity markets, then you ought to know exactly how the business you're potentially investing in, or maybe you already have invested in, actually makes money. Furthermore, even if you're not a value investor, but if you have the desire to understand what a business's value actually is relative to its price, then first of all, you better understand how it makes money, and secondly, you better understand how to value it relative to how it makes money. So that's why I've created this video. For those of you who are new to my channel, my name is Jared Ayers. I'm a CFA charter holder, and I've been investing my own money for over 20 years. And as a result, I've created this channel to share with anyone who's interested the thought processes, techniques, and strategies I use to invest in the public markets. So as a bit of background on why I've created this video today is I've seen a lot of videos and information on other platforms regarding valuation, a lot of focus on earnings, and valuations and assessments based on earnings. Now, nothing wrong with earnings. Earnings are fantastic, but I think you do have to understand what earnings are relative to other metrics that different businesses generate in order to make a profit and make money at the end of the day. I think the number one thing that you have to ask yourself as an owner of a business or a prospective owner of a business, even if you're just a tiny little shareholder in a publicly traded company, is, if you take the perspective of a private company owner, they always ask themselves, how much do I have in my jeans at the end of the day? As a prospective owner, you have to ask yourself the same question and then ask yourself, okay, so what am I willing to pay for that? I think if you can answer that question, then I think you've probably solved the valuation riddle. So let's start with the easiest business category to value, in my opinion. That is service businesses. So these businesses generally, like the name implies, offer a service, have quite healthy cash flows. Operating cash flows are generally available for management to use at their discretion. Earnings and cash flows generally move together in these types of businesses. If they have recurring revenue streams, they're even easier to value. So when you're looking at earnings multiples or discounting models that look at either cash flow or earnings, you're not going to be very far off, because earnings and cash flow generally move together, which makes them easier to value. So in terms of the range of complexity, service businesses are definitely on the easy end of the range, just because of their simplicity and predictability as well. The next category of businesses I want to discuss about valuation are capital intensive businesses. Now, there is a range in even this broad category of different types of businesses, and I just want to touch on a few of them. So if you think about an energy producer, say oil and gas, the nature of those businesses is there is a lot of upfront capital expenditure required to basically prove out the reserves in a well and then build the well, and then basically they can harvest after that. So in that type of model, because of that requirement to invest in the business, always drilling more wells to basically improve or increase production, which is obviously going to generate the revenues and bottom line earnings. One of the things you need to think about is, so there'll be operating cash flow, which is basically your revenues minus your operating expenses of actually producing that oil. But secondary to that is, in order to continue to maintain the business, you got to continue to drill more and more wells. So what's basically at the discretion of management is the cash flow that's available after they have reinvested to at least maintain the business. So what we call the term for that obviously is free cash flow. So free cash flow is really your key thing to focus on in oil and gas or energy producers, as an example. And from a valuation standpoint, therefore, it's not really a price to earnings so much as it is a price to cash flow, or price to free cash flow more specifically. Flipping that around, you can look at the free cash flow yield, which many oil and gas stocks these days are actually showing very healthy yields, higher for most than it's worth to even bother expanding their actual drilling capacity. So what a lot of them are doing instead of actually investing that capex into new equipment is actually buying back their own stock or paying down debt with that free cash flow, which is probably a reasonable decision to be making at this stage in this sort of energy life cycle. So that's one of the areas of capital intensive businesses I wanted to cover. Sticking with capital intensive businesses, the next sort of category I do want to touch on is manufacturing. So in a manufacturing type business, very capital intensive as well, but rather than sort of an upfront capex and then kind of just a harvest of the revenues and cash flows, with a manufacturing type business, you have generally a fixed plant and equipment that needs to be maintained, possibly even reinvested in to improve technologies just to keep pace with productivity requirements or what competitors are doing in that same space. So it's a slightly different type of model. Again though, what's at the discretion of management to have really is the cash flows after that reinvestment has taken place. So earnings isn't really going to give you a good handle on that. I've also seen capital intensive businesses measured on an EBITDA basis, which I think is extremely dangerous. To ignore depreciation and amortization of your plant and equipment is, I think, a bit foolish if you're trying to actually value a company for its long-term potential. Maybe on a short-term basis those metrics are used, but for me I think it's silly for a capital intensive business to actually ignore its cost of capital. So again, free cash flow as a relative to the company's price, comparing that to its peers within a manufacturing space, specifically maybe even focusing on within specific industry that you're looking at, would be a good approach to use there as well. So the third type of capital intensive businesses that I wanted to cover off is airlines. Again, a slightly different twist on the first two. Airlines obviously have massive fleets of aircraft to maintain, to cycle through. Obviously though, they can actually replenish those aircraft, so they may use them for say 2, 3, 4, 5 years and then roll them into either say a new lease if that's how they're doing it, or they may sell them off and buy new ones. You gotta look at a number of different things there, but because again you still have that sort of requirement to reinvest in the fleet, then again free cash flow is still a powerful driver of that type of capital intensive business. But there's a few other things with airlines that you do have to think about from a valuation perspective. They are tied a little bit to commodity prices with oil, and there are, I guess, other nuances that you have to be able to understand. Are they expanding into new routes? Those types of things. How full are their planes? All those types of things. So, there are other valuation or business considerations you need to think about, but certainly at the end of the day, what's available to shareholders is that free cash flow, and that should really be guarded as a place where you want to look to first when valuing, again, that type of capital intensive business. So the next area that I want to discuss in terms of types of businesses is banks. So I can probably do an entire video, much longer than this one, just on bank analysis and valuations. They are difficult if you want to get into it and actually do the work. They're not necessarily simple creatures, and I think people maybe that invest in banks are probably just staying at it or looking at it from a high level, looking at the dividend and saying, okay, that looks safe and that's a good place to park my money for a while. But if you do want to get into it and look at the valuation, how to look at a bank from a value perspective, I think I'll touch on a few things here, but certainly there's a lot to it. And so I guess the first thing really that you want to look at from a bank perspective is, okay, how does a bank earn its money? And the primary way, for traditional banks, is the interest rate they are paying on deposits relative to the interest rate they are earning on loans. So that spread is known as the net interest margin. And that really is something that you really want to focus on when you're looking at traditional banks and investing in them. Obviously, if you have a net interest margin, 3% or greater, then that's probably a good thing. But you also have to have a bit of a macroeconomic view when you're looking at banks, because they are not necessarily dependent only on their own little worlds. They are at the mercy of the Federal Reserve in the U.S., central banks in other countries, of course, and the interest rates that they set as well, from just an interbank borrowing perspective. You also want to look at, from a lowest cost producer standpoint, the banks that are able to acquire money at the lowest possible cost. That's something that if a bank is able to do that based on whatever resources they have available, then that's something to look at for sure. Other things you want to look at from a bank perspective, return on equity and return on assets. Return on equity obviously is how efficient management is using or employing the equity of the bank into actually producing revenues and profits, but also return on assets, which encompasses not just the loan assets, but all the other fixed assets that the company has as well. So that's another area that you want to look at for sure. The other side of analyzing banks and determining value is the risk side of the bank. So they may have a very, very large and growing loan book, but how many loans do they have on their books that are maybe non-performing? What allowances do they have for loan write-offs? Those are other things that you want to look at. And banks aren't necessarily super comparable, especially in the smaller jurisdictions. They may be concentrated to a certain geographical region. They may be focused on a certain type of lending, or be at the mercy of a certain market because of where they're jurisdictionally located. Other factors that you may make it a little bit more challenging to compare banks would be other businesses they're in. So if they're into trading, or if they're into wealth management in a meaningful way, then those are other businesses that you have to sort of look at and from a holistic kind of big picture standpoint. So it's not super easy. I mean, you can look at earnings, but earnings are going to be driven by a number of those factors that I just kind of mentioned. So your ability to again have that kind of macroeconomic lens, understand how well the bank's being managed and what the future prospects are for it, is going to give you the best sort of position from which to analyze what the potential value is and what that looks like relative to the price. Again, if you can compare banks that are kind of in similar size or similar nature in terms of what their primary business is, then that's going to give you probably the best way. And then looking back, I guess, at the history of that bank and how it's performed from an earnings perspective, and how that net interest margin has expanded or contracted, and all those factors as well, is going to give you a pretty good basis for being able to value banks. In terms of other financials, insurance companies and that, I mean, I'll leave that to another day. The accounting sometimes for big insurance companies can be daunting to understand or wrap your head around, so sometimes it's actually easier just to move on to easier businesses to understand when it comes to sifting through the massive sea of potential investments. So the last business category I want to touch on, and this is by no means comprehensive, there's a lot of other little areas I could go into, but the other one that is a big chunk of the market in many instances is REITs, or real estate investment trusts. Looking at those again, earnings or even payout ratios, if you're looking at it from a sort of dividend perspective, you want to look, I think, a little bit deeper into it. Certainly from a pure value standpoint, looking at the net asset value relative to the price is a good place to start. Generally speaking, I find publicly traded REITs are generally, you can pick them up at a discount to their net asset value. Of course, the net asset value being kind of looking at the portfolio of properties that the REIT has, looking at what the valuation is relative to the cap rate for a certain type of real estate in a certain type of market. will, less any, of course, debt that is on the books for those properties will kind of help you arrive at the net asset value. But I think looking at that as a starting point will give you a good basis for the value relative to the price. In terms of performance, it's again you're gonna have to look at REIT by REIT, depending on where it's geographically located, depending on if there's any dependencies it has in terms of certain industries, if it's in a type of property or concentrated into a type of property that's potentially in decline versus one that is becoming more and more popular. Certainly with the whole Amazon craze and warehouse space and light industry type areas and developments, those are obviously more popular versus REITs that maybe are concentrated in an area where there was a lot of oil and gas sector activity, catering to those types of locations, which may have reduced over these past few years. Of course, it does depend on your macroeconomic sort of view of where everything is going, whether things will be moving up or down in a certain industry or a certain jurisdiction or geographical region. So not the not the easiest things to value, but at least understanding from how they do make their money. From that perspective, I guess, looking at what cash flow is available. I mean, depreciation probably isn't as big of a deal when it comes to REIT investing, mainly because most of the assets in the portfolio generally appreciate in value, don't depreciate. So, looking at something that removes that depreciation amount, funds from operations. Or maybe adjusted funds from operations, meaning that they're still taking into account some of the maintenance capital that is required to maintain properties, from just looking at how the REIT actually generates its own available cash to then make those payouts and or acquire other properties and or pay down its debt. So just some thoughts on REITs, among other things. So I hope just a bit of a sprinkling on how to look at different types of businesses may help you when you go and are perusing the reams and reams of opportunities out there in the public equity markets. So I hope that video was helpful for you. If you do want me to cover off different types of businesses in separate videos to make it a little bit more detailed and show exactly how I would walk through an analysis and valuation, I'd be happy to do that. But please leave me a comment if that's something that you'd like to see me cover in the future. If you did like the video, do hit the like button, give me a thumbs up. And if you're new to my channel but you'd like to see more of the similar content, then please hit the subscribe button if you haven't already subscribed. Until next time, thank you very much for watching.